It is Thursday the 12th. Good morning. On our agenda today, AI gazumps the estate agents, Republican rebels trigger a Trump tariff tantrum, and another mega earnings day.
OK, let's talk about these markets. If you live in macro land, nothing is happening. And that's really, really interesting. And let me give you a few examples of what is going on, because it's going to influence today. Euro dollar is trading at 118.62. Why is the dollar not stronger on yesterday's payroll number? I think is a really fascinating question. Equities went nowhere yesterday at an index level, at a top-down level. Below the surface, huge moves, really interesting moves. We'll get to those in just a moment. So everybody has to be a bottom-up analyst. Look at what is happening with Lenovo this morning out in Hong Kong, down by 5.2%. It's down because memory prices are up and its margins are getting squeezed. It was a similar story for Cisco overnight. It could be a similar story today for some of the European tech names too. Keep an eye on that. But keep an eye on what is happening between SK Hynix and Samsung. That battle is getting bigger. How long does that story last? So much to talk about this morning. The countdown to the opening trade starts right now.
Welcome to the programme, everybody. This is the opening trade, Thursday, the 12th of February. We have a lot to talk about, as Guy was saying, a whole host of topics to discuss. Let's go first to the growth story out of the UK. We've had UK GDP coming in, and this is for the quarter, so we're adding in December's numbers to what we already knew. And the number has come in weaker than expected. The pound has wobbled on it, or wobbled into this number, as you can see there, pretty flat as a result now. 0.1% is the quarterly growth number for the UK economy. That is a little more sluggish than the 0.2% that the Bank of England and analysts were expecting. There was a doctor's strike in here. Bloomberg Economics, though, saying that things are likely to get better, as suggested by some of the survey data, and as interest rate cuts continue to pass through the economy. Lots to talk about then later in the show. We'll discuss all of that with the Exchequer Secretary to the UK Treasury, Dan Tomlinson. He will be with us a little bit later on this hour. If we park the UK narrative for a moment, Guy, let's get back to some of the big picture topics you were talking about around how the market's dealt with the latest round of AI nervousness and the jobs data.
The jobs data I thought was fascinating. Let's start there, and then we'll get to the AI story. Kind of go from the macro down to the micro. Why didn't the market react more to the jobs data? I think it's what didn't happen around the jobs data and then what did happen around the jobs data. The jobs data was super strong. This is a good number out of the United States. It is a positive picture. Does imply that maybe the Fed doesn't cut as much. But why didn't the dollar strengthen? I think that's a really interesting question. Why didn't equities do more on the back of this? The index levels went nowhere yesterday, but below the surface, you break down what happened yesterday. You saw a really defensive tilt to the market, which I thought was fascinating as well. Why wasn't it more positive?
Is it because we're not sure what good news is anymore?
Well, is that appears bad news, doesn't it?
Right. Well, that's been the playbook for a long time. President Trump keeps trying to tell us that good news should be good news for stocks, but we're not entirely sure whether we're in that environment, I suppose.
So the number was, just to reflect on the number, 130,000 is the number of jobs added in the non-farm payrolls that were delayed, of course. That's more than double the estimates. John Authors has a great piece out today breaking down and zeroing in on the age group between 25 and 54 and saying that if you look at that data set in terms of that working age population, 80% of those people are employed. So he's suggesting if you zero in on the 25 to 54-year-olds, you're looking almost like full employment in the US, which poses the question, and the reaction, where we did see the reaction in the markets, it was the front end of the yield curve with yields up.
A little bit.
And a little bit of repricing, repricing in terms of June moving back to July for the next cut from the Fed. But how do you, as Walsh, justify and make the case for additional cuts in an environment where the jobless rate has moved down from 4.4% to 4.3%?
And there's lots of people coming out on the Fed, the FOMC, saying just that, which I think is interesting. Just in terms of the data, just in terms of what happened with the data, and then you put the AI story into the mix as well. But there's just continuous churn below the surface. What is interesting yesterday in terms of the sectors that did well in the States: energy, consumer staples, materials, utilities. That's really defensive. Healthcare's in the mix as well. The financials index, communication services, consumer discretionary all did badly yesterday. But you're getting this kind of churn. The real estate story, what is happening in the software space more broadly, that continues to churn at the bottom of this market, which is really interesting.
So real estate services was yesterday's version of, I've lost count, legal services, wealth management, all the areas of the market that we've worried about with regards to AI. Let's talk about, this seems quite retro now, Tom, tariffs.
It does feel very retro, doesn't it? And this is, and we were discussing, of course, in our editorial meeting, this is less about the likelihood of tariffs being removed or adjusted until, of course, a Supreme Court decision.
Yep.
This is more about a political blow for President Trump in the lead up to the midterm elections in November. We had a number of rebels, 6 Republican rebels in the House, who voted alongside the majority of Democrats to essentially sanction President Trump over tariffs targeting Canada, specifically Canada. Now, in order for this to become law, because the Senate has passed similar legislation, it would have to be rubber stamped by President Trump. There's no sign that he would do that. So it's very unlikely it actually changes the arsenal of tariffs aimed at Canada. But what it does do is remind us that the cost of living crisis, the impact of tariffs, particularly for those Republicans in those states that have heavy trade ties with Canada, that is becoming more salient. And it's very difficult, it seems, for President Trump to address that. This is a source of deep concern for Republicans in the lead up to the midterms.
I think that's the takeaway from this. It's a political story. It's concern around what is happening into the midterms and what impact you could see post the midterms. But I think we need to take what you just said and think about what the world looks like post-November. If Trump does lose the House and the Senate, it looks far away, losing the Senate, but it's possible. How does the political landscape change? Does he double down? Does he ignore congressional kind of oversight? What happens in that world, I think, is interesting. Yeah. And it points to potentially more volatility, not less volatility for financial markets.
Yeah, absolutely. So if you were seeing midterms as a time when things got easier, maybe that's not the case. I thought it was interesting in the context of tariffs, though, that recent Bloomberg economics analysis has focused on the fact that it seems to be US importers who have been paying the price of these tariffs, maybe in some cases passing that on to consumers. But it's not the case, according to this analysis, that last year we saw the exporting countries paying the price of the tariffs. It has been the US importers who've been doing it. That is according to Bloomberg Economics. Let us move on to the earnings stories that we have out this morning. There are plenty of them. I will do my bit and start with Hermes. So on the luxury side of things, Q4 sales at constant FX coming in better than expected, 9.8% higher. The estimate was 8.2, so that seems to be a beat on expectations. Resilient Birkin bag demand seems to be the headline. I mean, why wouldn't you? When gold's going higher, or it was... Sure. Is it today? Not today. Exactly. Gold might be some store of value, and so is a Birkin.
So from the discretionary to the staples story, at UniLever, of course, Coleman's mustard, mayonnaise, Dove.
These are important things.
These are essential items, of course. You can find others out there, of course, as well. So this stock is up about 8% in the last 12 months. The redhead across the terminal for UniLever. Fourth quarter underlying sales. A pretty decent beat, increasing 4.2%. The estimates have been for just shy of 4%. So a bit of a beat coming through for fourth quarter underlying sales for Unilever. They see 2026, this is the look ahead, they see 2026 underlying sales of a range of 4 to 6% at the top end. The estimates have been for 4.1%. So that's decent in terms of the top end of that range, coming in above expectations, announcing a €1.5 billion share buyback as well. So that's a stock to watch.
Let's talk about AI disruption and security. OK? Verisure brings both of those two things together. Company listed back in October, out with numbers this morning. Adjusted EBIT margin above 26. The EBITDA line looks a little light, which is maybe where the market will focus this morning. We're about to find out. And the EBIT line, the adjusted EBIT line, looks ahead of expectations. Now, what is interesting here, and we're going to get to this in just a second, is that this is a company that listed in October. Its stock generally has then come down below the listing price. But last few days, we've seen it potentially being impacted by the AI trade and disruption around the AI trade. Is that right or is that wrong? Well, let's find out. Austin Lally is the CEO of Verisure. Good morning.
Well, good morning. Nice to be back.
Yeah,
great to have you back.
Yeah, thank you.
I hope you've enjoyed life as a listed company since October. Come with a few bumps along the way, and last week was fascinating. Kind of beginning of the year. There's been this AI turbulence in the market. As Anna says, it's affected all kinds of different things, like the legal sector, the software sector more broadly, but it's affected you as well. And I'm just, do you see AI affecting your business right now? Is there any evidence of AI in these numbers this morning?
Yeah, actually, one of the reasons we're sort of quite calm, confident, forward-looking is we're obviously actually an AI beneficiary.
OK, you're not a victim?
No, we're an AI beneficiary, and I think we're going to demonstrate that progressively over time. We're already using AI to great benefit in many aspects of the business. And if I take maybe the core of what we do, which is the security service that we provide, I mean, it's basically what we call detect, verify, intervene.
Yep.
We're actually using AI algorithms already to do a better job of analysing incidents,
right,
of confirming whether it's, in a sense, a false positive or real. And we think we do that better than anyone else because we've got a proprietary system, right? It's a closed system. We've got 6 million customers. We've got about 85 million devices.
Right.
We're getting audio, video 24/7 from those devices. We're using that to train our algorithms. I mean, I would say to win in AI, actually, it comes down to what's the quality of the training data that you have. And we've actually got more training data of higher quality than anyone else.
So you don't see Anthropic coming out with a plugin that's going. This is what seems to be happening on the other side. You don't see that happening.
Certainly not. I mean, our business is really about eventually human intervention.
Yeah.
It's about when you assess an incident, being able to respond to it. I mean, we've always been effectively like I would call it an outcome-based business. And so AI actually contributes to positive outcomes for us. And I think over time, investors will see this.
OK. Good morning to you, Austin.
Good morning.
Yeah, interesting to see how the market gets its head around the complexities under the hood of these various stories then. If I look at the numbers then, fourth quarter adjusted EBITDA looks a little light of what the estimates were, but maybe there weren't that many estimates. EBIT looks a little better. I wonder how that informs your full-year guidance. What are you telling the market about the year ahead?
Yeah, I think EBIT's the more relevant measure for us given how much we invest in customer acquisition. So that's really primarily what we've guided on. Actually, the adjusted EBIT in the quarter, I think, is a bit ahead of expectations, as you noted. Very happy with that. I think we came in at like 953 million of adjusted EBIT. That gives us confidence, actually, in the 2026 guidance. What we've actually guided to is that margin increasing to over 26% next year. We're also confirming the guidance we gave at the time of the IPO on our revenue. So the annualised recurring revenue came in very strong in the quarter at 12.7%. Now, about 2 points of that is the impact of the acquisition in Mexico that we closed in Q4. So what we're guiding to for 2026 is that will be about 10%, which again is exactly what we said at the time of the IPO.
Getting new customers on the books must be really important to your...
it's the key, the whole thing,
key thing
about
for
the
your
story.
business.
Exactly.
And so what do we watch to know how easy or difficult that is for you? Because we sit around this desk every day talking about all kinds of volatility in all kinds of global markets, growth stories, the ebbs and flows of all the data and the like. What is key for you? What do you watch? What dictates whether people are prepared to enlist you? I
think what's interesting is that we grow at a pretty consistent pace, even when the macro situation changes. And the reason is because the penetration is so low. I mean, if you look at our biggest markets, Iberia, Nordics, where we started, the penetration is only 10%. I mean, only 10% of homes and small businesses have security. It's not like we're running against this kind of mature market where the economy makes the difference. I mean, it clearly has, an impact on the margins. But in general, it's the penetration opportunity that allows us to keep growing, consistently.
So you see it as a structural growth story, not
so much basically we're the market maker.
Yeah.
I mean, we are the number one advertiser. We're the number one brand. We basically take 2/3 of the market growth. I mean, the market grows because we go in and invest to grow it, right? We spend about 8 to 9% of our revenue on category creating marketing. I mean, that's in a sense the primary driver of the growth.
Do you face a trust deficit? I mean, we've seen hardware, we've seen surveillance systems in Israel hacked. Israel's pretty on top of these kind of systems. They had their own systems, home systems hacked during that conflict with Gaza. You talked about video and audio and all that data that you collect. Can you give an ironclad guarantee? Even WhatsApp encrypted, and there's been reports that analysts at WhatsApp and at Meta have been analysing personal data. Can you give an ironclad guarantee that data is protected and that your team are not looking at it?
No, I think we're the absolute best in class in this. And I'll give you an example. Any of the images, for example, or data that we would get from the customer, that's only accessible when an alarm incident is triggered, right? So it's not that we're on a 24/7 basis operator staring at your home. It's when there's an alarm incident triggered, that data then gets accessed by the alarm monitoring centre.
But is that part of the story? You have to convince. But is winning customers' trust part of that friction as you try and grow beyond 6 million?
No, I think, in fact, because we're the market leader, because we're the number one brand, because we've been doing this for year after year, I think we've actually built up a major trust advantage.
Okay. What do you get in terms of customer numbers? Where are you by the end of the year?
Well, we're not guiding on installation volume, but we're currently at 6.2 million almost, right? We just crossed the 6 million milestone towards the end of last year. It's been a very consistent story. if I look back over the past decade, we've basically tripled the portfolio over that time. And if you think about that 10% annualised recurring revenue growth that we've guided to for 26, I mean, that'll be a combination of volume growth, right, and it'll be a combination of some pricing.
You paint a really stable, steady picture. You paint a positive picture. Stock's below the IPO price.
It is.
12.50. It went out the door at 13.50 back in October. What gets you back? Is there a lock-up problem with some of the PE investors that you think's holding the stock back? Is it the AI story? What gets you back north of 13.50 and maybe reaches some of the analyst targets, which are much more positive?
Yeah, they are. Listen, I'm disappointed at how the stock has traded, right, in the most recent period.
Why do you think that is?
Yeah, but I think as CEO, it's quite important that we're not, I would call it, chasing the ticker.
Sure.
I think what I've got to do is focus on delivery.
Yeah.
But
why are you disappointed?
Yeah, because I think that, this is a growth story. We posted a great set of numbers in Q3 after the IPO.
Yep.
We've posted another really strong quarter today. Now, what I believe is that if we keep delivering this effectively double-digit progress on revenue and this strong progress on profitability, I think eventually markets will see the fair value in the company.
Cool. Lovely to see you.
Thank you.
Thanks, Austin. Thanks so much for being with us this morning. Really appreciate it. Austin Lally, the CEO of Verisure. Coming up on the programme then, still lots to discuss. Cisco gives a tepid margin forecast for the current quarter due to surging memory chip prices. We'll watch European market read across. To what extent is there that direct read across? We'll have a look into the European session this morning. Plus, Schroders CEO will be with us. Richard Oldfield joins us exclusively, 8:15 London time. This as the asset manager, the storied asset manager, agrees to be acquired by a subsidiary of Nuveen in a deal valuing it at just under £10 billion, $13.5 billion. So really exciting conversation that will surely be. Up next, we will take a look at some of the big moves in the markets this morning, including Japan's super long bonds extending their post-election rally. If you have questions, if you want to get in touch, IB plus BBTV Go is the function to use on the Bloomberg terminal. This is Bloomberg.
Welcome back. We are 40 minutes from the opening trade. Happy Thursday, everyone. European futures pointing to decent gains, up 0.7% after a flat session yesterday. The earnings story front and centre, and also digesting the data out of the US yesterday, Anna.
Yeah, absolutely. Working in some of those earnings stories. They've come thick and fast this morning, haven't they? Let's take a step back, though, and think about the macro story. Our Markets Live executive editor, Mark Gudmore, joins us now for a few minutes on these markets. And Mark, let's start with Japan, if we could, because since the election, we seem to have seen quite a lot of retreat from some of the earlier Takaichi trades that the market had been playing quite strongly. So the yen has strengthened and continues to do so a little bit today. 153 is where we trade right now on the yen. What's the context around that?
Yeah, good morning, Anna. It very much seems to be this buy the rumour, sell the fact type of event. And people are now suddenly building this whole new narrative. But this is a turning point for the yen, because now that Takaichi will have 4 years to implement her policies, it's pro-growth, it's a buy Japan moment. We have certainty what's going to happen. And therefore, the whole narrative that we are trading on the yen is all wrong. And therefore, the yen's going to turn around. It's undervalued and it can start a big macro trade. As we've talked about a lot, the macro community loves buying the yen, constantly wrong on this. And so it's very easy for that narrative to kind of get momentum. I'm not sure it sustains. I think it can last for a couple of weeks, a couple of months. But the fundamental reasons for being bearish to the yen have not changed. Even if Takaichi makes a difference in the margin, this is still a very slow growth economy with a very large debt pile that offers deeply negative real yields that are unappealing. And so therefore, I think the ongoing story is that if yen rallies maybe for a couple of weeks or a couple of months, it's just a great time to re-implement carry trades and fund to buy the risk assets in the yen, which Japan itself does. That's what Japan Inc. does in en masse. And therefore, I don't know how long this change in narrative happens, but I don't believe it. I won't get on board. I'll just stay quiet to the chance to get bearish the yen again. It will come.
Eventually. Why didn't the dollar go up more yesterday? Why did the front end only move a little bit? That was a strong payroll number.
It was a very strong payrolls number. The reaction in yields surprised me. I would have thought yields would go much further. I understand the flattening move in yields, but I would have thought, it should be overall a bigger shift higher in the yield curve, right along the curve than we saw. The dollar move doesn't surprise me as much. We've talked a lot. The world is overexposed to the dollar on a structural basis, and that needs to change over the coming years. It's not going to happen overnight, but every time there's a spike in the dollar, it's another chance to offload. Hedging ratios need to improve. The dollar is 1 year into a multi-year downtrend. That has many more years to go. So dollar weakness is never going to particularly surprise me. The backdrop here is that if you get weak data, oh my God, well, it's justification for cuts and it's to sell the dollar. If you get strong data, well, maybe the Fed will still cut rates, and that's even worse for the dollar because they've got terrible monetary policy. Basically, it's heads the dollar loses, tails the dollar loses. That's the kind of the underlying backdrop we've got for the year ahead in the dollar.
Mark, another day, another set of anxiety, another round of anxiety when it comes to the AI apocalypse, the assassination, another sector, real estate. How anxious are you about this, and to what extent is this a broader market impact?
So I'm really surprised that the overall index level is holding up already, given the immense rotation we're seeing. I still kind of think we see a little bit of an equity shock in the coming weeks on some of this kind of wealth damage that's happening out there, some of the portfolio damage that's happening. But in the terms of the fundamental level, I don't think that the AI is going to savage jobs quite as quickly as some of the doom-mongering timelines. I believe it's happening. I'm not a Luddite in this thing, but I just think it's farther down the line.
OK, it's the time horizon that is in focus. Bloomberg Markets Live Executive Editor Mark Cudmore. Mark, thank you. Remember, you can get up-to-date, of course, analysis and insight from Mark and the rest of the team. Just go to MLIV, go on your terminal. Here's the day book for you today, then. Here's what else to be thinking about above and beyond what's happening on the earnings front. We'll get some details, of course, stateside as well on that story. 9 a.m. UK time, the IEA oil market report. Brent has been gradually grinding higher towards $70 a barrel. We continue to keep an eye on what's happening in Iran and the US build-up of military forces there, of course. But that oil market report is out at 9. 1:30 p.m. UK time. Further detail, further colour on the state of the labour market in the US with US initial jobless claims. And at 7 p.m. UK time, the RSA State of the Nation. So, President Trump, State of the Nation. Later, is that President Trump? RSA, State of the Nation? No, where is that?
Sounds like
South Africa.
Yeah.
OK,
yeah.
We probably know, wouldn't we?
State of the Nation is coming. The State of the Union is coming.
South African, State of the Nation, Ramaphosa.
Yes,
OK,
all of those things.
We'll zero in on that.
Trump is coming.
Emerging markets. The Rand is performing quite well. Earnings, I'm drifting off a little bit. Earnings, we're going to get L'Oreal, which is going to be interesting. Airbnb, Coinbase, given the rout in crypto, all of that is on your agenda. There's a picture of the South African leader which would have helped me with that assessment. Guy, what are you watching for?
Just don't know how to follow that, really. Let's update what is happening. Apple's long-planned upgrade to Siri has run into a few snags during testing over recent weeks, potentially pushing back the release of several highly anticipated functions. Bloomberg has learned that the company is now looking to spread the rollout of new capabilities over a longer period of time instead of releasing them in the next operating system, which, incidentally, is planned for March. The latest hitches are part of a long and trying saga for Apple, which first announced plans for the revamped Siri back in 2024. Feels like a very long time ago, June 2024. Bloomberg has also learned that Anthropic is nearing the completion of a deal to raise more than $20 billion in a funding round co-led by investors, including Peter Thiel's Founders Fund, D.E. Shaw and Dragoneer. The investment group, the funding round has become a who's who of Silicon Valley and Wall Street investors. Other participants include Blackstone and BlackRock. Sources say Anthropic is set to be valued at around $350 billion in a deal that could be announced as early as this week. And President Trump says he's told the Israeli Prime Minister Benjamin Netanyahu that he intends to press ahead with talks with Iran. In a Truth Social post, Trump says nothing definitive was reached during their meeting in Washington, but he insists his preference is to reach a deal with Tehran. Netanyahu's office, meanwhile, says the two leaders agreed to continue coordinating closely, which basically means they didn't agree.
We have the CEO of Schroders coming on.
We do. This is huge.
On the show.
This is huge this morning. Massive deal.
Massive deal. Nuveen, 9.9 billion, almost 10 billion pounds.
Absolutely. This is going to shake up London. It's a continuation of a trend, but it's a fascinating transaction that comes this morning in that space.
Stay tuned for that interview and for that conversation. There's a lot more as well on the FX space. Stay with us. This is Bloomberg.
What is it? Wednesday, Thursday the 12th. Thursday the 12th. It's Thursday. And it's the 12th. We're 30 minutes from the start of the opening trade. Stocks look like this, okay? So we're gonna bounce this morning at the get-go. The CAC's going to have a really good day. We're going to see what happens with Hermes. I'm fascinated to see what happens with the FTSE. Schroders is called up 20% this morning. We're going to talk to the CEO very, very shortly. I can't kind of reinforce this enough. Nuveen takeover, massive deal. Tom's got some really interesting facts. We'll get to those in just a minute. Euro Stock 50 futures up by 0.8% at the moment. So we do get a bit of equity action at a headline level this morning, which I think is interesting in itself. What's happening in the bond market?
Yeah, let's have a quick look at bond markets. We have been watching what's been going on in Japan, of course, and the post-Takeichi trade, the post-re-election of Takeichi. There's been some focus on that this week, hasn't there? It's certainly at the long end of the Japanese curve. Not much action here in Europe, though, as you can see. Not much movement at all. A little bit of selling, just very much at the margin. The focus on the jobs report yesterday over in the United States. As we move through this week, we get towards the inflation report. That will be the next real focus for global bond markets then, Tom.
Yeah, so the data was in focus yesterday stateside, as was this vote in the House, a rebuke, essentially, of President Trump's tariff policy, even if it won't materially change it, at least in the short term. Donald Trump's tariff policies suffering their strongest political blow yet.
On this vote, the yeas are 219 and the nays are 211. The joint resolution is passed. Without objection, the motion to reconsider is laid on the table.
The Republican-led US House passing that legislation then aimed at ending the president's levies on Canadian imports. The move signalling growing anxiety over the White House economic agenda ahead of those midterm elections. Let's bring in our Washington Deputy Bureau Chief, Laura Davison. Laura, fantastic to get you on and your take on where this leaves President Trump, his tariff agenda, how much of a political blow this is.
Yeah, so in terms of practical effects, Donald Trump is going to just march right ahead with his tariff agenda. The only thing that could stop him is the Supreme Court, which is due within a decision here in the next couple weeks about whether these tariffs are constitutional. But in terms of the politics, this House vote shows that this is a really tricky issue for Republicans. We had a lot of situations here where you had only 6 Republicans who broke with the party, but a lot more were privately very uncomfortable and sort of hoping this would pass, even though they publicly voted no. Republicans are headed into an election year. They're trying to hold on to their House and Senate majorities, but that's really an uphill climb. And as voters are really concerned about the economy, cost of living, and they're blaming these tariff policies, it gets harder and harder for them to publicly embrace them.
Why are they feeling so gloomy about all of that when the labour market looks okay? The jobs data yesterday was good.
Yes, the labor market is good, but if you look back in the past year or so, it's been one of the weakest years for labor, going back, several decades. So we constantly hear this disconnect between what voters are saying that they're, that they feel like their paycheck isn't keeping up, grocery prices are too high. Well, the underlying fundamentals of the economy look good. This is really the trap, though, that Joe Biden fell into. He kept saying, look, the data is good. Why aren't you feeling it? Trump has also sort of headed down that road. This is very tricky, politically for him to manage, and why you're seeing him put pressure on the Fed to cut interest rates. This data that we just saw indicates that the Fed might be more reluctant to cut interest rates here in the next couple months. But this is something that Trump has repeatedly said, and he has his pick to lead the Fed, Kevin Warsh, who needs to go through Senate confirmation, who has pledged that he will try to turn the central bank into a more dovish position.
Yeah, don't really envy Kevin Warsh at this point, given the conundrum he faces potentially. Bloomberg Washington Deputy Bureau Chief Laura Davison, fantastic. Thank you for the context around what we're seeing stateside around tariffs and the data as well. Meanwhile, the so-called quiet quitting of the US dollar came across a little louder after a blowout, and that blowout January payrolls number that we've been discussing making no sustained positive impact on the greenback. The Bloomberg dollar index is down for a 5th straight day. Joining us now is Kirsten Kunby-Nielsen, FX strategist at Danske Bank. Kirsten, why are we getting weaker dollar on stronger data?
Yes, good question. I mean, at the beginning, of course, we got a rally, but I think just yesterday's data goes to show that investors are keen to sell into rallies. There is still this very much negative sentiment around the dollar. We're also seeing in its position in data really stretched to the short side. So I think that's why. And then one thing that I really took notice of yesterday, in terms of the non-farm report, but also these negative benchmark revisions, we're seeing just a structurally slowdown of employment growth in the US. So we're definitely seeing some divergence there, in particular to the euro area. And I think that's why we're just not getting the reactions that we are.
That's interesting. I mean, we've had confirmation of Kevin Warsh to the Fed. Is that story, though, around Fed independence, is that still having an impact on the dollar, or have we moved past that in the market conversation?
I think it's something that really kind of alleviated this pressure that we saw a couple of weeks ago where euro-dollar bounced up towards the 120 mark. I think just alleviating these concerns in terms of Fed independence, in terms of what we're seeing with different rulings on Lisa Cook, etc. So it's not as much a market theme. I think it's something that helps euro-dollar consolidate around the current levels, definitely. But again, I think it's supposed to step a bit more into the background now that we have this nomination.
Kirsten, good morning. It's Guy. Can I ask you whether or not we should all care about Norwegian inflation? And I ask this question because Norwegian inflation surprised massively to the upside. And it comes after the Australians, for instance, have decided that they also have an inflation problem. We've got the RBA raising rates. We've got CPI coming out of the States tomorrow. We've just had strong data coming out of America. And I'm wondering whether the market is going to shift back to being really worried about inflation. And this kind of creeping inflation theme that we're starting to see emerging around the world is going to impact the major crosses.
No, definitely. I think it's quite striking. I think it's also something that we're kind of seeing in just the manufacturing sector. We're definitely seeing some more bullish signs there. It's striking the divergence we have between central banks, as you mentioned. We have the Bank of England still very much signaling that they're going to cut rates. We have the RBA a lot more on a hawkish path. I think there is some potential for that, at least for some economies, that will start to, again, be a bit more worried about inflation, definitely. And also just remembering the global backdrop. I think the global economy has been surprisingly resilient. And again, these more bullish signals from the manufacturing sector, it's definitely something to be attentive about.
Well, there's inflation in Japan, isn't there? The yen is currently up 0.2% at 152. It's had a decent run of gains in the last few days. Our MLIV strategist, head of MLIV, Mark Cudmore, former FX strategist, said he would lean into the carry trade. Would you, Kirsten, at this point? Have the gains in the yen run a little too far?
I don't think so. We're actually quite bullish on the yen. I think there's definitely some things in terms of that dollar yen is kept kind of on the top side given intervention risks. That's one thing. But I think just narrowing rate differential, as you say, inflation is still to the strong side in Japan. Also, the economy, I know it's not a booming economy, but the growth backdrop is actually quite solid. So I would definitely favor actually going for a stronger yen against the dollar. I don't think it's come too far. I think we can get below the 150 mark.
Kirsten, what's changed there, though? Is that because you see the BOJ, you got confident, maybe the election makes you think the BOJ will keep hiking rates or something? I mean, what is it that's changed recently that has led to the strength in the yen? Is it actually to do with the market being convinced that the US could perhaps get involved in some intervention?
I think the big move that we got a couple of weeks ago definitely has something to do with the rumors about rate checks that were occurring. So if we could get some joint intervention between the US and Japan. I think also just this verbal intervention that they remain quite focused on not having a too sharp move higher in dollar yen. And then also I think the price action has been quite interesting just since the election. Focus is, of course, what we'll get in terms of the budget for the fiscal year 26 in Japan, but also just looking at the JGBs. I mean, price action has been actually quite more muted the past couple of days since the election. So maybe we're just getting something a bit more calm, a bit more stable, a bit more predictable now. And I think that's something that can underpin the yen.
Justin, you mentioned the Bank of England a few moments ago. You said that the Bank of England is at the kind of more dovish end of the spectrum. It's going to be cutting. There are signs, and I know you can't see it in the data this morning, which is slightly weaker than anticipated on the GDP front, but there are signs that the UK economy is beginning to gain a little bit of traction. How easy is it going to be for the Bank of England to cut rates at this point if the rest of the world's rate-cutting cycle is beginning to stall?
No, definitely. I think when we look at the UK, I think, and the Bank of England, of course, they're a very split committee. I think they find it just as hard. We have these notoriously split votes where we have 5 members voting for unchanged, 4 voting for a cut. So I think there's definitely also some disagreement within. I think when we look at the UK and the Bank of England in terms of the entire interest rate backdrop, we're not necessarily back at neutral. So I think that we can still see some 1 or 2 more cuts from the Bank of England because it's just removing some of the tightness, some of the restrictionness of monetary policy. But it's definitely striking, and I think that's something I am very keen to watch, just the divergence again between central banks. But I think the weakness that we're seeing in the labour market, if we're starting to see some more alleviating inflation pressures, I think that could open the door for some more easing. Also, just remembering they tend to have this kind of dovish bias within the Bank of England. They really have a bias just towards cutting rates. So if the door opens up, if we get some weaker data, I think they can continue.
Kirsten, great to get your take. Thank you very much indeed. We'll follow the politics in at a later date. Kirsten Colby-Nielsen, the FX strategist, joining us from Danske Bank. Let's talk about the story of the morning, and that is Schroders. So the investment bank got sold in 2000. The asset manager is now looking like it's going to be sold in 2025. The family are selling. This is a huge story for the City of London, a real kind of changing of the guard. You've got some amazing... what was Schroders originally set up to do?
So 1804 was when it was set up, originally for arranging bonds, financing, arranging and issuing bonds for major infrastructure projects. Sound familiar? Including power stations across Europe, the Americas and Asia. At the time, 1804, we're in the middle of the Napoleonic Wars. The UK and France, and Pitt the Younger. William Pitt the Younger had just begun his second premiership.
I'm sure some of that skill set still lives on, which would be useful at this time when we're talking about data centre build-outs and all the rest. But 2 centuries of independence for Schroders then coming to an end here. They are going to be retaining the Schroders brand, which I think is interesting because it is one that, recognisable. This story caught all our attentions this morning when it broke on the Bloomberg terminal. So it definitely is recognisable. It does create one of the world's largest active asset managers with nearly $2.5 trillion in assets, which is interesting. And and London will be the non-US headquarters of this business. But of course, but Nuveen started in Chicago.
9.9 billion price tag. So there's some upside here. The stock looks like it's going to move quite significantly at the get-go. But it's a continuation of a trend as well in terms of consolidation within this asset management space.
Yes, absolutely. And M&A trends, they're all the rage at the moment, aren't they?
UK assets.
UK assets being attractive.
US buyers finding value in UK assets.
Is it a diversification trade when it comes to those from Chicago coming and looking maybe potentially outside the UK?
And how does the AI story fit in here? The amount of investment that's going to be required to deliver on the technological change that's needed for these businesses to stand up to AI threats and to embrace AI opportunities. How much of that is driving the investment?
So
we've got loads of questions. Fortunately, we've got someone to answer
I was about to say, we're about to get the CEO on. So we're going to have Richard Oldfield on 8:30 UK time. You definitely do not want to miss this interview. It is coming up right here on Bloomberg. Richard will be joining us shortly. Market open 17 minutes away. We'll see how the stock trades. This is Bloomberg.
Welcome back. We are a little under 15 minutes away from the start of the opening trade this Thursday. European futures on the front foot after a flat session on Wednesday. Pointed gains of 0.7%. There's some really interesting stories at an index level and at a corporate level as well. US futures also pointing to gains around 0.2%, Anna.
Yes, let's talk about the UK economy, shall we? The UK has grown less than expected in the fourth quarter in another setback for Prime Minister Keir Starmer. GDP rose 0.1% in the final 3 months of 2025, which falls short of Bloomberg estimates of 0.2% growth. The figures mark a disappointing end to the year in which the economy was forced to navigate huge tax rises, US President Donald Trump's trade wars, of course, and a devastating cyber attack at the largest UK car manufacturer, which mattered more than you would expect to the GDP data that we've been talking about this year. Joining us now is Dan Tomlinson, UK Exchequer Secretary to the Treasury, Labour Party MP, of course. Very good to have you with us, Dan. Thank you.
Good morning.
For joining us. There was a hope that maybe after the uncertainty of the budget was worked through, that December would look better, that December would be more positive. But this data set doesn't seem to show that turning a corner story. What do you think's going wrong?
Still going up. And the thing that I'm really interested in when I think about the pace of economic growth is what's happening to GDP per capita. That's what translates into rising living standards for people across the country. Last Parliament had GDP per capita fall, worst on record. In terms of wages, you were talking about Napoleon, I heard when I was...
You were listening.
We have the longest squeeze on wages since Napoleon was making his way around Europe under the last government. We're turning that around. We had the fastest wage growth in the first year than we had in the first 10 years of the Tories. And GDP per capita was falling in the last Parliament, -1 in 2023, 0 in 2024, +1 this year. We can see that things are moving in the right direction. Of course we want to go further. Of course we want to go faster. There's definitely more to do. But we are seeing growth increase And we're also seeing that the UK is the fastest growing economy of the European
So your
G7
message is the
economies.
comparisons with Napoleon, with the last government, with other parts of the G7. No, that was nice. No, I liked it. I liked it, Dan. Thank you. The comparisons you say then are favourable. But what about the lack of confidence in the growth strategy? And I'm not even talking about the City of London here. I'm talking about within your own government, within the cabinet. We saw those WhatsApp messages from Wes Streeting that suggested that he doesn't understand where the growth is going to come from. Now, if even members of the cabinet don't buy into the growth story under Keir Starmer, then what hope for the rest of us?
We have a really strong growth story and a Chancellor who's obsessed with getting our economic growth rate up and increasing our productivity and our economic potential. We've got to focus on economic stability. That's one of the things that has delivered the 6 cuts in interest rates that the Bank of England have implemented since we came to power in July last year. That's also enables firms to do the investment, which is the second pillar of the growth strategy. We're seeing investment increase. The growth in investment in the UK economy was twice as high in 2025 than it was in 2024, up from 1.7 to 3.4%. That investment will drive long-term growth, and that's from both public and private sector. Yes, we've increased public sector investment. We need to do that in the UK. We've been living off our past for too long, our roads, our railways, our infrastructure. We need to invest in them, but alongside the private sector. And then we're implementing really significant reforms too to our pension system so we can unlock that capital, to our planning system so we can get things built again.
So you believe in it. Guy?
Is the Chancellor slowing down deregulation because she wants to do a deal with the EU?
The Chancellor is very focused on what we can do to make sure we can pull back those barriers that are standing in the way of economic growth. One of the big things we need to do is change our planning system, continue to change
Could she deregulate faster if we weren't thinking about getting a better relationship with the EU?
Well, I think that one of the things that people often want to say is that it's not possible to both motor on domestically and focus on relationships both with the US and the EU. But what this government has shown is that we've been able to get the prosperity deal, and we're working closely to deepen that with the United States, and then to continue to make progress in deepening our relationship with the European Union too. Our objective is to, deepen our relationship with the European Union, strengthen our ties with the US too, and then make sure we can motor on and get our own house in order when it comes to regulation, productivity.
Do you think
and
a different leader
of
the Parliamentary Labour Party would be able to manage that relationship, EU, US, in the same way that Keir Starmer has?
I think Keir Starmer's managing it really, really well, and we aren't thinking about a different leader. What we're thinking about is working with Keir Starmer, Rachel Reeves. That's the top team that was elected in 2024. People, they have a strong mandate to deliver for the British people, and that's what they're focused on. That's what I'm focused on too.
The fiscal rules were changed in 2024 to allow the Chancellor to spend more on things like infrastructure. Can this government be bolder on that? Can you use that more to generate the kind of growth that this economy needs? Is there more that you can do on that front this year?
One of the really key things that this government wants to do, and this is one of the Chancellor's priorities, is to get borrowing falling. It's really important we do that. We are seeing borrowing is forecast to fall in every single year of this forecast, fastest reduction in borrowing in the G7. So it wouldn't be right, it isn't the government's position that we could do more by borrowing more to invest more. We think we've got the balance right. The key thing, though, which is incredibly important, is that the money that we are borrowing for investment, that we spend that well. So we've got the National Infrastructure Transformation Authority, NISTA. It goes in, looks really carefully at our infrastructure projects. One of the problems we've had for decades in the UK is that when we build something, it always overruns, it always costs too much, and we don't get a good bang for buck for it. So we want to make sure that we can do that differently, make sure that when we do build things, we're not spending like the last government did, this 120 million on the back tunnel on HS2 or whatever it was.
We've got this big deal in the financial sector today, which is Schroders and Nuveen taking a bid, looking to take this over for about £10 billion. Does the Treasury welcome that kind of takeover?
We do want to see people coming to the UK and looking to invest in the UK. That is a good thing overall. Both people domestically being able to choose to invest, individuals, but big businesses too, and also we're a small open economy, right? We in the grand scheme of things, one of the things we need to do is make sure that we are open. We're working with businesses in other large economies to make sure we can get the investment into the UK.
This is a positive sign. It's not a sign that assets and companies are undervalued in the UK.
I don't think so, no.
OK, so welcoming it. Just a final comment on another story that pushed stocks up in the housing sector yesterday, so it's important to get some clarity. Are you working on, even behind the scenes, some kind of revised Help to Buy scheme? Because the market got excited about that possibility yesterday.
So what the government is focused on is doing all we can to get to our 1.5 million new homes target. That is so important.
Do you see merits in that kind of scheme?
I'm not going to comment on particular schemes or stories that may or may not have been made up or got into the press. I don't know. I'm the tax minister. You're asking me about something. You're asking me about something that isn't to do with tax. But we do need to make sure that we are doing all we can to get to that 1.5 million new homes target. Okay. That's both about public sector investment, work alongside the private sector, and then these reforms to the planning system, which, by the way, the reforms to planning that we made in 2024, the OBR revised up long-term growth, revised up the revenues coming into the Exchequer because of those reforms, and they said that was the single biggest non-fiscal change that they had made. So it was good news doing those sorts of things for the fiscal position.
If you want to come and talk about taxes anytime, you're more than welcome.
Come back.
We should ask more about tax. I apologise.
Next time.
Thank you.
There's some interesting kind of survey data on taxes out over the last couple of days. Dan, great to see you. Thanks for stopping by to see us. We really appreciate it. Dan Tomlinson, MP, Exchequer Secretary to the UK Treasury. It's quite a title. Anyway, let's talk about Schroders and talk about what is happening here. Stock looks like it's going to bounce. Being taken over by Nuveen. Big change in the City of London, you could argue, but a continuation of the kind of consolidation we've seen within the asset management space.
I thought it was interesting. I mean, Dan is still here, but it's interesting that clearly not naming this particularly, but broadly welcoming the kind of investment flows that we're seeing, and this deal potentially, at least on its merits. So we'll see that.
Got a lot of corporate earnings to factor into the market open as well this morning. Plenty of German corporates reporting. We'll certainly pivot to that story. Get an update on what's going on at various German corporates in the next hour. This is Bloomberg.
So nothing happened in the US equity session yesterday. I'm joking, of course, but if you look at the index levels, you could be confused into thinking that was the case. US stocks finished really flat despite the really strong payroll number. Loads of corporate activity going on below the surface. What is going on? Well, basically, everything's cancelling itself out. And in some ways, what you are seeing in terms of the AI churn is being matched by what you're seeing in a really strong performance in consumer staples and utilities and these kinds of stocks. You're getting a real rotation within the market. And you just don't see it here. It's not there. You can just see this market just going sideways, doing nothing. But below the surface, interesting things are happening, Tom.
Yeah, rotation below the index level, but also regionally as well. Worth noting that Asia and the MSCI Asia Pacific best start to the year now versus the S&P in a century. European futures on the front foot this morning, pointing to gains of 0.8%. Some really interesting idiosyncratic stories, some corporate stories, the earnings stories, of course. FTSE 100 futures pointing to gains of 0.5%. We look at real estate and maybe some pressure there on the AI story, but also in terms of financial services, the Nuveen bid, £9.9 billion for Schroders. Certainly that will be in focus and can lift the broader sector around financial services. DAX futures pointing to gains of 0.4%. The CAC count should be mentioned as well because Hermes came out with a beat and CAC count futures are pointing to gains as well, Anna.
Tom, let's have a look at some of the individual stocks that could be in focus. We've talked about it a few times. We will continue to do that. We've got the CEO on shortly. Schroders is in focus. Nuveen is buying Schroders for just under £10 billion, creating one of the world's largest active asset managers, of course. Siemens in focus, raising its outlook. Demand for factory automation products, boosting returns. Orders including, of course, for data centres, so that's a focus. And EssilorLuxxotica could be an area of movement in the markets as well, riding a boom in demand for AI-powered glasses of all things. Guy.
Let's take a look at this market open. You can fold in Mercedes, you can fold in German industrials, you can fold in what impact high chip prices are having in names like Ericsson and Nokia. So much going on in terms of the corporate activity that we're watching at the moment. But it cancels itself out a little bit. Today we're going to see maybe a little less of that. So we're expecting actually markets to climb reasonably strongly today here in Europe. 6-7/10% maybe is what we're anticipating. But below the surface again, there's some really interesting corporate activity. We're a bottom-up market. It feels like it's been a top-down market for a long time. Are we starting starting to see a little shift in that. FTSE 100's up by 0.6%. 600's up by 0.6%. IBEX is up by 0.5%. Took ages to get the CAC 40 to open yesterday. What are we going to see this morning in terms of the activity there? And Germany's got so many single stocks that we need to be focusing on. There's a sector story below that, above that as well. Let's focus on that. Tom, what are you seeing?
Yeah, let's dive into the sectors then. You're seeing a bit of a relief for the tech stocks, actually, on a sector basis. Just getting the latest reading. So tech at the top of the list across your sectors so far. Names like Relex gaining a little over 4%. It is now third best performer across your sectors. So tech up 1% as a sector. Consumer products, so therein lies luxury gaining 1%. Basic resources, after a strong session yesterday, also posting gains so far of 1%. On the downside, just 3 sectors so far in negative territory, including the safe haven tilt of utilities, down 0.4%, along with real estate and chemicals. Just 3 sectors in negative territory. Broadly, that positivity is there on a sector-by-sector basis.
Yes, we talked at the top of the last hour about the numbers out of Hermes, and it's been so busy, we haven't mentioned them since, but that is it seems a positive story for the luxury sector, and so that's pushing that particular sector higher. So Hermes itself is up by 2.9%. I see that Bruno Cucinelli and some of the other names in the luxury space up around 1.5%. So we've had earnings already, and they've been kind of mixed from the sector, but Hermes just underscoring some of the positivity, I guess, this morning. Lots of the German names not open, it seems, yes.
We'll wait for those.
Yes.
They'll be here in a minute. You're getting a rotation away from what has done well, I think, over the recent days. This kind of defensive tilt that we've seen in the market. Yeah. British American Tobacco, National Grid, beginning to roll. Unilever's in the mix there as well. So the stocks that have done kind of okay recently may be beginning to maybe move off. But on the other hand, just to kind of flip that around, Anheuser-Busch is doing really well this morning. Second best performing points stock, third best, up by 3%. So I don't know. I'm trying to find a line through this, and I guess the corporate news and what we're seeing elsewhere maybe confuses that picture.
Yeah, it does a little bit. Let's get some analysis on these markets this morning. Banu Buwaja joins us, Chief Strategist at UBS Investment Bank. Banu, good morning to you. We spend a lot of our mornings over the last couple of weeks talking about AI and which is the sector that is the market's concern that day, and it seems day in, day out to rotate from one sort of subsector of white-collar jobs to another. Yesterday was real estate. I mean, how are you navigating these waters where the overarching indexes aren't necessarily responding to this story, but underneath the hood, there's quite a lot of volatility?
Yeah, there's a lot of rotation. Many people call it broadening, but there are quite a few different types of trades going on, right? So what you've seen over the last several months is low quality, I'm talking about the US primarily here, low quality companies have significantly outperformed high quality companies. You've seen small caps beginning to outperform large caps, which is interesting because that says that the equity market believes this is early cycle because they're thinking we're going to get a fiscal boost, we're going to get a monetary boost, economic growth is doing just fine. So the equity market thinks that this is early cycle, which is actually quite interesting because the credit market and the labor market, which are more reliable sort of cycle clocks, they're more reliable indicators of where you're in the cycle, they're telling you're late cycle.
Yeah.
You know, the default rate cycle has come down and it's now just about beginning to pick up. Unemployment has come down, well, just about beginning to pick up. This is late cycle stuff, whereas the equity market's behaving, I think, primarily because of the fiscal boost, behaving like this is early cycle. And I think that rotation from large cap to small cap and low quality and high quality companies to low quality companies, I think that should be faded. We should go back towards high quality companies. And I think at this minute we should be quite careful with small caps, whereas the market actually is going headlong into that.
Is that because you think we are actually further through the cycle? Or you think that actually the cycle isn't, the cyclical story isn't setting the agenda, it's a structural one?
It's a good question. That's 2 reasons. First, because I think we are further down the cycle, and also because I think while there is some sign of revival, like you saw it in the ISM, you saw it in capex orders, you saw it yesterday in the labor market, things are looking just a little bit better. But you're also going to see higher tariff inflation come through. Tomorrow is a big number on inflation. And that number, we think, is going to be above consensus. Consensus, I think, is about 32 basis points on core month on month. We're looking for 38 basis points. But not just next month. Over the next 3-4 months, we're looking at high inflation at a time when savings rate for the U.S. consumer is at 3.5% at a low ebb, at a time when real disposable income growth is barely positive. That, we think, will tell on the consumer, and I think that will lead to a rotation back towards high-quality companies, back towards large-cap stocks.
Banu, you haven't mentioned AI yet. So the rotation is a cyclical story. It's not an AI defensive play.
So the market is moving away from AI, right? But it is moving into low-quality companies like profitless tech in recent weeks, in recent months has done quite well. They're moving away from the AI names, they're moving away from tech, but they haven't moved necessarily into the most defensive names. They moved into consumer discretionary, they moved into financials, they moved into mining, energy, so they've moved into deep cyclicals, the kind of stuff that in the Q3 earnings season had done extremely well, but the Q4 earnings season is a much more mixed season.
It's a cyclical story, but it's also a defensive AI play because their sector's less likely to be disrupted by AI. That's another factor, isn't it?
Well, I'm not sure I would call it defensive, because if you look at the low-quality companies, it's hard to put a line through this. The guy's right. If you look at low-quality companies, they have significantly outperformed high-quality companies. So I'm not sure the market's playing defense. It's going into deep mining. It's going into energy. It's going to financial. So I think it is an early cycle story in the US. That's the way the market has been playing it. And I'm sure that I'm thinking that this probably should not be the case. We should probably be moving towards high-quality companies.
So not a broadening. Broadening is the wrong way of thinking about this.
No, actually, it is a broadening because if you think about performance, Guy, in the last 12 months, 9 companies out of the Russell 3000 drove 72% of the gains. That's going to broaden out.
Okay.
Right? That's going to broaden. So the performance is going to become broader. So more stocks are going to drive it. But it is, I think, going to be higher quality stocks than sort of the low quality or the
Is tech going to be, like, when I come back, is what I want to come back to still going to be there?
I think so. I think we eventually do want to come back to tech. I think software names have derated quite a lot.
Okay.
Semiconductor names have tremendous visibility in terms of their earnings over the next 12 months. So the market is not taking down their margins, but their margins, expected margins for the next 2 years are extremely high. This is 40 to 45% margins in the semi names. They're extremely high. I don't think the market will be able to sell them right now because every result that you get from a semiconductor company, whether it's ASML or it's TSMC or anything along the food chain.
What about the memory companies? Samsung and ST Hynix look like they're going to go toe to toe.
I think they will still be quite strong. In the near term, I think the semi cycle will go quite strong.
Okay.
I think it's the software names that we will probably come back to first. I think market is still invested in the semis. That's quite a big overweight for the market. Until that comes down, I don't think we can go headlong into tech and say tech is now cheap. I think we first have to start bargain hunting in the software names before we do it in the semis.
Let's talk about that bargain hunting in the software names then, Banu. Does that mean then that all that we've seen over the last couple of weeks has been overdone? I mean, if we indiscriminately sold, we don't want to indiscriminately then buy back. So what are we looking for? What have we learnt about which of these businesses in the software space will be resilient and find an opportunity in AI and which will be eaten?
Yeah, that's absolutely right. So look, I mean, AI is not just going to be about LLMs, right? It's not just going to be about ChatGPT and so on and so forth. In the future, quantum computing right now is still somewhere between reality and fantasy, but you have robotics, you have the medical applications of AI. The companies that can move into those spaces, robotics and medical applications, the companies that can sell software into those spaces, I think that is going to be, those are the companies that are going to survive. I'm not going to go into individual stocks, but we do think that Microsoft, for instance...
But that's specialist software then?
It is specialist software, but as a whole, I think that sector can do well. So it's not like those margins need to go to zero. Last year, it was a bit of a surprise that DeepSeek came and went, and nothing happened to software margins. This year, Anthropic did for the market what DeepSeek couldn't last year, and put these margins under a cloud. But I think that the sell-off has been indiscriminate.
Sorry, you were about to say something about Microsoft.
No, we do think that it has come off quite a lot already. So that is a company which we think is a quality company that we would actually be going back into right now, rather than going into small caps and thinking about a major renaissance in the US economy.
It's interesting as you're talking about embedding AI in tech. You've got EssilorLuxottica up double digits, and of course they have this partnership with Meta. They've been very successful in selling those AI enhanced glasses. So that's maybe one example. A lot of our guests are talking about diversification outside of the US, into Europe, into EMEA, into Asia. Guy was talking about SK Hynix and Samsung. Where is that story in terms of how much diversification do you want out of the US at this point?
I think you want tactical diversification, right? I mean, let's be clear. US's earnings profile is one that is very ambitious, right? The market is overall looking for about 15% earnings growth. That needs to come down, right? But let's also be clear that US does deliver earnings, right? In the last 3 years, the average CAGR of EPS in Europe has been 0, right? So at this minute, if you think about European earnings, they are beginning to look slightly better. Japanese earnings are looking much better. Real disposable income in Japan is just about to get positive at a time when US real disposable income growth is going to come up. So I do think that geographical diversification over the next 3, perhaps 6 months does make a lot of sense. I don't think that's your structural asset allocation. I think your structural asset allocation is still long the US. tactically, it does make sense to be in Asia. It does make sense particularly to be in Japan. It makes sense to be in Europe. Australia, Canada, you're seeing decent numbers coming out of these countries.
What I'm seeing at the moment is with all this churn, US equity markets are just doing this. Like, at an index level, nothing is happening.
Absolutely right. And
does that carry on?
That carries on for the near term. I mean, we're expecting the S&P to be at 6850 by the end of March, right? So we have been expecting this for some time because we think that there is this real tussle. Even at a macro level, there's a macro tussle, there are micro tussles between moving away from tech. Do you move to small caps? Is the rotation to an equal weighted S&P or to Russell?
But most people invest at an index level.
Yeah, and that's the problem. So at an index level, for the passive investor, for the ETF investor, I don't think you're going to see tremendous gains in the S&P. This is one of the reasons why we want to diversify away from the US for the next 3 to 6 months, but not for the long haul. So at a macro level as well, does the fiscal give you help, or does the inflation, which I think is going to be higher in the next 3 months, take away from you? So at an index level, we're expecting the market to not give you strong returns in the next 3 months. Later in the year, the S&P heads towards 7,500, but by end of March, we'll probably be here where we are.
Okay. Always a pleasure. Nice to see you, Barney. Thanks for stopping by. Barney Wager, Chief Strategist, joining us from the UBS Investment Bank. Call 6 looks like this. Let's quickly show you because I want to talk about Schroders. I want Chloe to talk about Schroders. That is what the market looks like. Generally, we are seeing some decent gains across the board. Luxury is having a particularly good morning on the back of Hermes. Let's talk about what else we're talking about this morning. Schroders is, hope, top of the list. Chloe Melly, over to you.
Good morning, Guy. Indeed, this is the big M&A story of the day. So Schroders is getting bought by Nuveen for £9.9 billion. And this marks the end of 2 centuries of independence for this asset manager, the largest standalone asset manager in the UK. And this is a company that had been struggling lately. And therefore, the fact that it is getting snapped up in this way is being taken very well by the market this morning. And we are up almost 30% for Schroders. Moving on to Essilor, and that is also doing very well. Sales for that glasses company came in much higher than expectations, and that is thanks in particular to really strong demand for its AI glasses. So that is the partnership that it has with Meta, and that is doing really, really well, and we are up more than 9% for Essilor. Siemens is also in the green this morning. It raised its outlook, and that is because it has made that move towards more industrial automation, more AI solutions, and that means that it is benefiting from really strong demand from factory automation customers and from data center customers as well, and so it had raised its outlook in as a consequence, and that is up more than 5.5%, almost 6% for Siemens. Adyen is in the red this morning. This is a payments processing company. The revenue missed in Europe and North America, and so that is creating some concern about the growth momentum going forward for that company. And we are seeing a major drop in the shares this morning, about 19%. And then the car sector is also in the red, led by Mercedes, which said this morning that it expects margin to remain under pressure this year because of that tariff uncertainty, because of that continued competition from Chinese rivals, and it is dragging down the rest of that sector. And we're seeing BMW and Volkswagen also in the red this morning as a result.
OK, our equities reporter Chloe Melly with some really fascinating individual corporate names and stock moves to focus in on this Thursday. Coming up, another one. Storied asset manager Schroders agrees to be acquired by a subsidiary of Nuveen in a deal valuing it at just under £10 billion. We will speak exclusively to Schroders CEO Richard Oldfield. That is next. Stay tuned. This is Bloomberg.
Seventeen minutes past the hour. Let's talk about the big story out of the City of London this morning. Nuveen is buying Schroders. £9.9 billion is the price tag. It ends more than 2 centuries of independence for the UK's largest standalone asset manager. The Schroders brand, will they be retained? And London will serve as the combined group's non-US headquarters and its largest office. The deal creates one of the largest active asset managers in the world, $2.5 trillion. AUM, assets under management. Joining us now for an exclusive interview is the Schroders CEO, Richard Oldfield. Good morning, sir. Why are you selling?
Well, Guy, I'm going to take us back a second. So there were 2 announcements this morning. The first one was our results, and it's important as context to the deal. Our operating profit was up 25% to 757 million. EPS is up 39%. This is a great business. It's in a really strong foundation. But what we are doing here is creating this powerhouse of asset and wealth active management. It's going to have an unparalleled breadth of public to private capabilities. And at 2.5 trillion, it gives us the firepower to actually invest in our business and make ourselves more relevant to clients. It's a business combination that's almost perfect on paper. We have total complementarity. There's no overlap in geographies, really. There's very little overlap in products. So we're about growth. We're not about taking money out of the system. We actually drive this business and create something really powerful. And the cultures fit, the heritage, the 300 years together. So it's not just, you mentioned our two centuries of history. Nuveen comes with more than 100 years of history as well. And that actually helps us have very similar cultures. And as you mentioned, Guy, this is all about the City of London. We put that right at the heart of the deal, making commitments to the UK and London.
Richard, did they call you? Did you call them? Where did the conversation start? How did it go? Kind of just give me a bit of colour here.
Well, as you'd expect of the last year, I've been talking to many of my peers around the world about how they respond to the industry challenges that we've got. And what became clear as I met Bill is that we had businesses that were very similar, and we discussed the complementarity. And that led to them approaching us with an offer earlier in this year.
Richard, good morning to you. So you mentioned there that this is about having the firepower to invest. Would it be right to say that AI has changed the landscape and the requirement to invest in that technology, to find that an opportunity rather than a threat, means that it's better done with a larger business? Is that one of the drivers?
Well, that's definitely one of the drivers, because the scale of this operation will be able to create more capacity to invest in our business. And it's not just about AI. Actually, when you think about our industry, it's about tokenization and distributed ledger technology. It's about reshaping our industry, about different distribution models. And yes, it's about AI in terms of how we do research, how we do portfolio construction, how we access wealth clients. So I think there's a whole range of technologies here that are going to transform our industry as other industries, and we need to be right at the forefront of that change.
You talked about making commitments around the City of London, Richard, and we read in our stories this morning that London is going to be the headquarters of the non-US business. What do those commitments look like, though? How watertight are they?
Well, they're all listed in the 2.7 offering document, and I think Nuveen have been pretty clear. London will be the non-US headquarters for at least 5 years. There are commitments about jobs over the subsequent 2-year period. We'll have about, to put this in context for you, Anna, there's 3,100 people in the combined group right here in London, and that's the largest location of any office for Nuveen, and it would be about a third of the overall workforce. So this is a big, sizable presence here in London. We're not stepping back at all from our commitment to support the UK capital markets, be at the centre of how policies are formulated, be at the centre of how people come to market. So I think the commitments are very watertight and they're very real, and I think it just shows the size of the UK and London in the overall group.
Richard, what are your commitments on jobs? Should we expect that there will be jobs that will go as a result of this acquisition?
Well, Tom, look, that's a great question, and lots of people are asking that. But there's a very firm commitment that there won't be job losses from this. Go back to why we're doing the deal. It's complementarity, right? We don't have overlapping investment capabilities. We're taking the strength and depth of Nuveen's private markets capabilities, fixed income and US distribution, and we're putting that with our public markets heritage, some of our specialist capabilities in private markets, and our UK, European and Asia distribution. So there isn't an awful lot of challenges here in terms of overlapping headcount. So there is a very firm commitment that people will keep their jobs, except for some PLC functions. Obviously, we won't need that going forward. And of course, we already had some plans from a transformation perspective. But I think it's a really firm commitment to keep jobs here, to keep talent here, to keep capabilities here in London and in the other investment centres that we've got across the world at Schroders.
What do you think it tells us about the broader cost structure pressures for active fund managers?
Well, I think what we've done really well over the last 12 months is show that we can actually take our own medicine, Tom, right? So we've been through a transformation programme. We've taken more than £75 million out of our P&L successfully this year. That's allowed us to drive the revenue up. So there's a lot that we can do to manage our own cost pressures as an industry. But as Anna talked about, there are new areas where we need to invest, where we need to develop new products. And that is best achieved when we actually have scale and broader capabilities for our clients.
Richard, was Bill the only conversation you had, Bill Huffman, the CEO of Nuveen? Did you talk to anybody else? Were there others in the bidding for the business? Would you expect somebody else potentially to come in? This is an interesting asset. Is there possibly somebody else that could be interested in it? I'm just curious as to how this developed and why you've ended up with Nuveen rather than somebody else.
So this business has never been up for sale, and that's quite important because we are confident in our own plan, Guy, and actually we have conviction that we can deliver value for shareholders. When this offer was made, it comes from an organisation that I respect enormously. It comes from an organisation that will drive value for our clients, for our people, and actually it is a price that I think is super attractive to our shareholders. At 17 times 2025 earnings were compared very well with similar transactions. We have got a premium on spot, I think, of 34%. We are at a 61% over a 12-month VWAP. So I feel really confident. Sorry, it's a 30% premium to spot. It's 34% over the last 30-day VWAP. So this is really attractive for our shareholder base. And what it does is it crystallises immediately the value in our organic plan, as well as actually the future benefits that we think we can achieve through that combination with Nuveen. There is support from our principal shareholder group. So that's sort of locked at 41% of the shares.
OK. Can I ask you, you mentioned AI. Are you clear on what AI will do to wealth management, asset management and research? Because the market seems to be wrestling with this question.
Well, I don't think any of us have the actual answer, Anna, and I think AI will change the industry, not just wealth management, but asset management as well, in ways that today we can't see. But we're already using it here at Schroders. We're using it in terms of how we connect with our clients. We're using it in terms of how we provide research. We're using it in terms of portfolio construction. So it's already changing the industry, and I think sometimes people think we haven't been changing because of AI over the last few years, but that has been happening. We'll continue to see change, but people also want to see people in wealth management, and that's a really important thing we've got to remember.
Rich, before we let you go, are you staying on as CEO or moving on elsewhere?
I am. I'm really excited by this deal. We're going to drive value for our clients, for our people. I think this is a great opportunity. Okay. So I'm committed to being here. I'll be the CEO of Schroders still, as from an international business perspective.
Richard, thank you very much indeed. What a big day for you and the team. Richard Oldfield, Schroders CEO. Coming up, the UK economy grew less than expected in another blow to Keir Starmer's premiership. We're going to dig into the numbers with Vanguard's Jumana Salahin. That is next. This is Bloomberg. This is the opening trade. We're 30 minutes into today's session. On the front foot, there's some activity in the equity markets this morning. Some decent gains at the headline level, up 0.5%. The FTSE 100 is actually the laggard right now, with gains of just 18 points. The strength really coming through over in France. The luxury sector is getting a lift, up 1.3%. Worth noting, of course, that financial services are one of the biggest gainers, as are banks. We're looking at Schroders, of course, a massive pop there on the back of the Nuveen deal. Up 0.9% on the DAX as well, gaining 226 points. Guy, what are you looking at?
So I'm getting slightly obsessed with this number here, OK? 370 up, 275 down. Day by day, you're getting a little balance, a little bit of more balance one side than the other. But basically, the market continues to just kind of pivot you get a little bit of upside one day, a little bit of down, but we're going sideways, and that's the narrative that we're getting. In so many ways, again, 277 down, 317 up. It's basically one for one. So that's the narrative we're looking at. Volume's a little better today, which is good. Let's talk about the deals. Let's talk about what we're seeing in terms of the numbers. Schroders is obviously up. We've just been speaking to Richard. The deal's been done. We're up by nearly 30% on that stock. Few wobbles, kind of whether we're up 31% or 28%, but we're basically at the kind of the offer price. Luxottica is having a great day. It's up by 8.41%. Is glasses the next form factor? Are they going to take over from the phone? Don't know about that. Siemens is up by 6.4%. So there's a number of kind of M&A deals, single stock stories, tech deals that are kind of impacting this market this morning. Downside, Adyen's under real pressure. That stock is down by it's down by 19%. So again, you're getting some real volatility in this kind of fintech space at the moment. Adyen down quite hard. Ice creams are also not having a good day, which is never a good day for anybody, to be honest. And Mercedes-Benz Group is down by 4.35%. That's rippling into names like BMW as well. So you've got you've got to be focused on almost the single stocks story narrative this morning to understand what is happening at the index level, which is really interesting because the index level continues to go sideways, Anna.
Yes, absolutely. Let's get an update on some of the other big stories we're covering this morning. Bloomberg has learned that Anthropic is nearing the completion of a deal to raise more than $20 billion in a funding round co-led by investors including Peter Thiel's Founders Fund, D.E. Shaw and Dragoneer Investment Group. The funding round has become a who's who of Silicon Valley and Wall Street investors. Other participants include Blackstone and BlackRock. Sources say Anthropic is set to be valued at about $350 billion in that deal. The Republican-led U.S. House has passed legislation aimed at ending President Donald Trump's tariffs on Canada. The vote signals growing anxiety over the White House's economic agenda before midterm elections focused on heavily on affordability. Trump is almost certain to veto any bill calling for a repeal of tariffs. And the UK economy grew less than forecast in the fourth quarter as business investment shrank and services stagnated, adding to pressure on the embattled Prime Minister Keir Starmer. Gross domestic product rose by 0.1%, lower than the 0.2% in Bloomberg's survey of economists. Tom.
Well, let's stay on that story and get some more insights and bring in Jumana Salahin, Chief European Economist at Vanguard. Jumana, good morning. Let's start on the UK economy then. How concerned should we be? How does it change your forecast for the year?
So it doesn't actually change our forecast for 2026. 2025 actually came in line with our expectations because, you see ups and downs month on month. So I wouldn't read too much into the numbers.
And 2026 forecasts are?
1% for
1% growth for the UK?
Yeah.
Okay.
Yeah. So that is below what we saw, 1.3 down to 1. So we see a weakening of the UK economy in 2026. And the story, I can tell you the story if you want.
Yeah, what's the biggest drag?
The biggest drag is obviously, wages. Real wages are going to come down. Inflation is falling, but real wages are falling by more. So the consumer doesn't have that income to support the spending. So we see that weakness coming through.
Okay.
Inflation.
Yeah.
What does inflation do? Because you can have the kind of 1% growth, but if inflation's kind of higher than that, we've got a problem. What is inflation going to do?
So inflation we expect is coming down.
Okay.
Right? So we've seen a little bit of movement up and down, 3.4 the last number, but we see it coming down to 2% by the end of 2026. So we're quite positive on inflation.
Which bits of inflation are going to come down? Because it feels like a lot of the inflation at the moment feels like it's regulated.
That's right. Right.
So I'm wondering what happens in terms of actually how the consumer feels in terms of the regulatory, in terms of the inflation picture.
Yeah, absolutely right. And we know that the government's taken some measures with its packages to reduce those regulated prices. So our estimate was it's going to take 0.2 off of inflation just from the regulated price adjustment. So we're going to see that coming down. And also across the board, we will see inflation, don't forget, is the change in prices.
Yep.
Right? So we are going to see that easing across the board for goods and services coming down. So it's not like one particular sector, but definitely regulated is going to come down faster.
Jumana, what story should I be telling about the UK economy right now? Because it's possible to tell a kind of gloomy one around services not living up to expectation based on the numbers out today. It's also possible to look at some maybe green shoots, we say that quietly, for the UK economy and think about that into 2026. Have we turned a corner from the budget? Is that what that narrative depends on?
Yeah, so I think the budget was a little bit positive news. Positive on growth because, on the margin, There was a little bit more front loading of spending, so that pushed up. So in terms of our forecast revisions post-budget, we revised up GDP from 0.8 for the whole year, 2026, to 1. So there was some positive, and inflation down by 0.2. So it was good news. But there is a structural force here, which is the UK economy has been at a 1% economy, not a 2% economy like the US. So there are some underlying forces here that, we do say the UK economy is stagnating. And we do get that in the latest data today.
Yes. We spoke to the Treasury earlier on, Dan Tomlinson from the Treasury, saying that they are obsessed with growth. They're investing into a fast-changing world, though, aren't they, with AI very much at the forefront of everybody's minds. How does that play out for an economy like the UK, which is very services-focused? It is very white-collar. And we spent all of the last 2 weeks seeing story after story about concerns about white-collar jobs and industries.
Yeah, absolutely. Great question. We think in our Vanguard Economic Outlook for 2026 that AI is going to be the most important long-term trend, the mega trends that we call, shaping the economy. Now, in the US and China, they're doing most of the innovation. Headline numbers for investment, 2 trillion. What is the UK doing? 100 billion. So we need to be doing more investment. Maybe we can't do the innovation, but can we do the adoption? Can we be using that technology, plug and play, that those big Mag 7 companies are doing the investment for? And that's really where the challenges is. And, the job story, white-collar jobs, whenever we see a transformative technology, what we call a general-purpose technology, Internet revolution was the first one. The second one we're seeing is AI. We are going to see jobs adjust. There will be, with everybody's job, there will be tasks which can be automated. So that's how we see it. It's more task-based.
You don't think the UK is specifically exposed? I have seen some research that says that the UK is more exposed than others because of the makeup of the economy.
No, I wouldn't say the UK is particularly exposed. Okay. No, it's more about can they adopt fast enough.
What are the productivity gains on that adoption story?
So the productivity gains are, they are numbers that are sort of less than 1%. We're talking 0.5%, the productivity gains that you can get from innovation. So that's kind of what we see, but on a long-term basis. So we're talking about the next 5 to 10 years. That's quite good, right? So if we can go up from 1 to 1.5, that's actually pretty good from productivity, from innovation, from AI, adoption from AI. Sorry, not innovation.
The BOE has views on AI, and I want to go back to your take on 1% growth and inflation coming down to 2% by the end of this year. Does the BOE have room to do more on rate cuts?
Yes, we've got 2 more rate cuts priced in. We think that probably next month there will be a rate cut, particularly on the back of the numbers today. So that's what we've got priced in, taking interest rates back to neutral territory, which we think is 3.25%.
Just before we go on to other subjects, if we see political instability in the UK, how upended do you think your models could be? If we see yields going higher, what's the effect of what will be the effect? If you plug in a high yield, what effect do you get in terms of some of the outcomes you see in terms of your models?
Yeah, so if you get the higher yield you have to think about, there's 2 sides. First of all, the real economy.
Sure.
And that really depends on that investment and that productivity. And I would say some of the political instability is already priced into markets in terms of, the investment cases. So that's kind of in. On the margin, what happens if you have those higher long-term rates due to political instability? That feeds back to hurt the government debt. So you start paying, more in that interest rate, right? So it's the long end of the yield curve which drives the amount that we're paying back for the gilts that we've borrowed. And that could lead to that negative feedback loop, which we're trying to get out of, right? The whole purpose of the budget, the narrative is, hey, if the budget can give us that growth, that allows the Bank of England to cut. That allows us to get into that positive feedback loop, and that's really the challenge.
Meanwhile, Germany is investing heavily, isn't it, on infrastructure and on defence. Excuse me, we get 2 stories here when we talk about this. Some people say it's not showing up in the numbers yet because they can't get the money out the door quick enough. Others say, it's all coming through. What are you seeing in the numbers?
So we're actually positively surprised. So they said 500 billion over 10 years. That's about 50 billion a year, right? So we actually saw spending close to 40 billion, which is great news because as you said, people are like, will they be able to spend it? Now, the question is, what are they spending on? So it turned out that they have twisted it more towards consumption rather than investment. And we would like to see, for the long term, if you can tilt it towards investment in defense, in infrastructure, in technology, that gives you that longer-term boost.
Jumana, thank you very much.
Thank
Indeed,
you.
Jumana Salheen, Chief European Economist at Vanguard. And we will get and continue to focus on the German economy, particularly the polls coming through from Siemens, which is having a very strong session after an outlook upgrade to its earnings per share. So the stock price is up about just over 6% right now. I spoke to the CEO of the German industrial powerhouse Siemens on the back of those earnings then, and found out what he had to say as well about the AI impact and the potential impact on Europe's largest economy. Take a listen.
We will see how dynamic, how fast AI is hitting really the real world. We believe that this happens very fast. But from that perspective, we see still there's a good growth. There might be shortages on power supply or supply maybe on GPUs. But since the supply chain is also ramping up, we believe that this keeps on going.
And you think that the CapEx spend, the commitments from those hyperscalers, $650 billion US potentially this year, that is rational?
I mean, I didn't make the math of all the commitment which everybody gave, including the investment banks. Adding that up, there might be a slippage, but if you take even a slippage into consideration, still enough money for a market to keep on going.
And you've got a record backlog now. About 120 billion euros is the backlog. What are the constraints around delivering that backlog? Are you able to deliver on those orders?
Clear, yes. I mean, we really invested early enough. So we doubled our manufacturing capacity for medium low voltage in the United States, exactly for data centers. We increased capacity for rolling stock. By the way, big backlog comes also for rolling stock. So we have capacity. We invested in capacity, also in capacity for our automation devices. So that's not the problem. We will deliver.
There is a currency impact. How and to what extent is FX impacting you, particularly euro strength, and how are you looking to mitigate that? Are you taking any hedging strategies around the currency?
I mean, we always do some hedging in the background. The impact, I think, is something like 50 basis points, and we planned the fiscal year on this weak dollar, and so therefore that's part of our planning. If that stays in that ballpark as we see today, that's part of our forecast and our planning.
Okay. You talk about the software part of the business. We've seen a significant sell-off, including industrial software names, in the last couple of days. What do you make of what we've seen there? How defensible is industrial software from the evolution of AI and some of these products being put out into the market now?
So we know that AI has the potential to disrupt some of the software businesses. I mean, if you talk about software which runs on call centers and the like, I mean, that's fully on the block. But if you go on the other end, on industrial software, simulation software, physics-based software, we don't see that at all. We rather see an enrichment of the software, which allows more and more customers to use it. Take, for example, simulation. Simulation is costly, takes a lot of time. Using GPUs, we can accelerate it 100 or even 1,000 times, making it accessible. Yet, the point is that you always want to frame it with the physics, because hallucination is not an option on a shop floor, neither in your designs. And this is where physics comes in. It always gives you a confinement of what really is right and wrong.
The Siemens CEO, Roland Busch, speaking to me there on the back of those earnings. And again, it's the data center push that's coming through, really offsetting. They continue to see weakness in the auto industry. He made that pretty clear. He wants to see a turnaround in the German economy. He says that more needs to be done. He thinks the government are putting in place the right policies. He wants to see growth of above 0.7%, clearly. He thinks that maybe they can get there. But data centers and that backlog, they have this huge backlog now that they have to fulfill.
He's a real believer, isn't he? Yeah. And despite acknowledging that in some cases there'll be hallucinations still at the moment, that's not an option in some of the ways.
Industrial software,
and that's not an option in the factory, is the way he ended that, which I thought was really interesting. But yeah, a real believer in the potential for his business to benefit.
You just see the numbers. You have to. I think if you're seeing these kinds of numbers as a CEO, you just got to go, I need to invest into this. You can't have any skepticism. You have. It's like the TSMC CEO. I'm a little nervous. I'm worried. Is this actually going to deliver? But the numbers I see in front of me compel me to work with
you
this.
invest through the worry. That seems to be the thing. We asked the ASML boss about that in the context of the TSMC comments. Are you nervous as well? He says, if you're not doing your job properly, if you're not worrying about that, that's what the job of the CEO is to do, to worry if the investment is the right one and the right scale. But clearly they see a lot to invest in.
Yeah, because these are real orders that they have to fulfil. And the question is less about whether those orders are going to transpire and more about whether they can actually deliver on those orders.
It's still a supply chain story. It's still a kind of, can I get the kit I need? Can I get the labour I want? All of these issues remain ever present, and you see it in the United States. You see it in the construction data yesterday, the payroll numbers. Can you build enough? Can you get enough people to work on the data centres to build the data centres?
Yeah, and interestingly, we were talking to Germano about the German investment story, and some people had said to us, this is going to, the numbers aren't going to get out the door quick enough. Germany has a history of not being able to spend the money it allocates to fiscal spend quickly enough. She was saying that there is some evidence it's getting out the door, but actually she wants to see it more on the structural side, on the infrastructure side, rather than on the more consumer-facing side. So that's an interesting one, because that's something we'll return to. And it's a big day for German earnings, German corporates, isn't it? We've had Mercedes out with numbers, and that stock's under pressure, down by 4.3%. So it's another day where some of those granular stories are perhaps more interesting than where the index sits.
But again, that's kind of how do you draw a line through this and come up with a narrative at the end of it? Is everybody just going to have to become a single stock investor, a theme investor? Can you figure out a strategy around that? People keep telling me that this is the time for active management, but active managers must be whipsawed at the moment in terms of the price action they're seeing.
And Bana Boejo of UBS coming out with a different view to many of our guests on this, which is that actually the cyclical story that he's starting to see, he's not compelled by that. And maybe tactically, over 3 to 6 months, that's where you go. But after that period of time, you want to be back in those stalwart US names for the earnings strength.
Yeah, precisely. Why do you want to come back? Because how long does this boom in America last? How long does the data continue to be supported? Is it just up until the midterms, or the market's going to price beyond the midterms quite soon? So do you start to fade that trade at that point? It's really difficult.
And it's interesting from the political landscape, how you respond to the global threats at the moment, and the fact that you want to promote your country's product, but you don't necessarily want to put up barriers to trade. And this came up when we were talking about the UK economy. You were asking about that of the Treasury. Well, Emmanuel Macron and Friedrich Merz seem to be on different pages when it comes to this. So on the German side, they seem to be saying, we don't want to put up too many barriers. On the French side, they're saying we really need to push the Made in Europe story.
Yes, so that debate between the leaders of France and Germany, I think we get more perspective now on the German economy. I think we've got someone standing by to talk about this, because, of course, we have had the earnings story coming through as well from a number of big industrial players in Germany. So for a broader context, let's bring in William Wilkes in Frankfurt. William, what does it tell us about the kind of impulse that we're seeing? What is the strength of corporate Germany? It seems to be a mix. Siemens is firing on all cylinders, it seems. Mercedes, the auto sector, continues to be under pretty significant pressure.
Good morning, Tom. Yes, you can see exactly in this morning's earnings some of the challenges facing German industry. On one hand, you've got Siemens, which is doing very well. They restructured a few years ago and shifted to focus on software, and that's starting to really pay dividends. It's higher margin business. It's a bit less vulnerable to shifts in demand. Whereas on the other side, you have the problem really that's hitting German industry, which is this new competition coming in from China, which you're seeing in the Mercedes-Benz earnings, where really what's going on there is you've got a company with very high costs and it's struggling to keep up in China against rivals that are getting better at engineering and manufacturing and have a much lower cost base.
And on the Mercedes side, we keep asking, William, whether we're at the end of the pain for the German auto sector. But now, with the rise of China, feels we started another leg on that story. That competitive threat really having an impact.
Yeah, indeed, and there's still quite a long way to go. Mercedes still sells a lot of cars in China, so there's room for further decline if they can't turn it around. And obviously, the other cloud hanging over them is no one really knows what the tariff outlook really is, not just in China, but also Europe is becoming more protectionist. The United States is becoming more protectionist, and China might do more to support their own manufacturers and shut out Western ones. And basically, that's a real headache for a company that, since the fall of the Berlin Wall, has made its business model about exporting between all these different regions. And now they have to kind of manage worsening global fragmentation. And that's a very, very difficult situation for any globally active manufacturer.
OK, William, thank you very much indeed. William Wilkes on some of the corporate challenges, particularly in the auto space, that continue with Mercedes, of course. And you can see the share price down around 4%. Very different story for Siemens as it leverages that software play and exposure to data centre demand. Financial services is one of the best performing sectors. It is top of your list right now. Banks following as well with gains of 0.9%. And we'll stay on that. We'll get some more details on the specificity around the comp for a particular CEO. What has Morgan Stanley's CEO Ted Pick been awarded in terms of the salary? We're going to give you the answer when we come back. This is Bloomberg. Welcome back. Before the break, we asked what has Morgan Stanley boosted CEO Ted Pick's salary to? The answer is $45 million. Morgan Stanley have pushed up Ted Pick's pay, up from $34 million after a record year for the Wall Street firm. The stock is up about 33% in the last 12 months. Pick took charge of the bank in early 2024 after years of leading its trading operations. Morgan Stanley posted its strongest year last year, with earnings per share hitting a record. The company has been helped by its push into debt capital markets, arranging financing for projects tied to that AI boom. Pick's pay compares to $47 million for David Solomon of Goldman and $43 million for Jamie Dimon of JP Morgan.
OK. Kind of takes us to our next subject, I think reasonably neatly. Morgan Stanley, big asset manager now. Schroders, now part of a bigger asset management group. So that's kind of my symmetry on this. So the company's been taken over. The stock is rising. I thought it was interesting. It sounds like it was kind of the Nuveen conversation was one that started. The offer was made earlier on this year. But it looks like they didn't put the business up for sale, which yes. I think is interesting.
Yes, absolutely. Let's listen into what we heard from the CEO of Schroders, Richard Oldfield, speaking to us earlier on. And we were keen to understand what it was that was driving this decision to do this deal.
What we are doing here is creating this powerhouse of asset and wealth active management. It's going to have an unparalleled breadth of public to private capabilities. And at $2.5 trillion, it gives us the firepower to actually invest in our business and make ourselves more relevant to clients.
The firepower to invest in your business. That was the thing that I took away from this. And also bringing more private markets.
With $2.5 trillion of assets under management, that's probably a fair assessment. Powerhouse.
But the AI was definitely part of the conversation.
Yeah,
there's kind of this need to invest.
Yeah.
Like you have to be a powerhouse.
Yes, even if he fully acknowledges, like a lot of other people, we don't know who exactly the winners and losers are going to be just yet.
That is it for the opening trade. The Pulse is up next. This is Bloomberg.